Welcome to this video lesson on relative series. After completing this video, you will be able to explain what is a relative series, why a relative series is needed. The stock's performance is dependent on these four factors: benchmark, currency, sector and stock specific. A relative series is an adjusted price series that is formed by removing the effects of the benchmark index and the currency exchange rate on a stock price. A relative series is needed to compare stocks traded in different countries, where each stock is quoted in a different currency, and is influenced by a different stock index. As we know, a rising tide lifts all boats, and similarly an index's sentiment can easily rub off on any stock. So while creating a long-short portfolio, removing the index's influence on a stock is very important. Assume that you are an investor based out of London, and you trade on Nasdaq and London Stock Exchange, or LSE. Now you want to build a long-short portfolio using stocks on both the exchanges. The stocks traded on Nasdaq are quoted in dollars, while those on LSE are traded in pounds. To compare the stocks on these two exchanges, you can convert the Nasdaq prices to pounds by dividing with the GBP/USD exchange rate and then remove the effect of indexes on the stock prices.